Every investor eventually faces that gut punch moment when they realize the government is about to take a massive slice of the profit they worked years to build. Capital gains taxes can quietly devour 20, 30, even 37% of your gains depending on your bracket, and most people don't even see it coming until it's too late. We're talking about a tax category that pulled in hundreds of billions of dollars from everyday investors last year alone. Not just the ultra wealthy. And the wild part is that most of the strategies to legally reduce that bill are sitting in plain sight, completely above board, used by the same people whose financial advisors charge $400 an hour to explain them. Think of capital gains tax like a toll road. You built the car, you paid for the gas, and now someone is charging you just to arrive at your destination. The good news is there are legal detours that have existed in the tax code for decades, designed specifically to reward patient, strategic investors who know where to look. The first thing most investors get wrong is timing, because selling too soon is essentially handing the IRS a gift with a bow on it. Hold an asset for more than 1 year, and you shift from short-term rates, which mirror your ordinary income tax and can hit 37%, down to long-term rates of 0, 15, or 20%, depending on your income. There's a famous line often attributed to Warren Buffett that goes something like, "Our favorite holding period is forever." And while that sounds like folksy wisdom, it's also a tax strategy in disguise. Every year you don't sell a winning position is a year the IRS has to wait. And time is genuinely one of the most powerful tax reduction tools available to you. Now, let's talk about tax loss harvesting, which sounds complicated but is really just the financial equivalent of balancing your karma. If you have losing positions in your portfolio, you can strategically sell them to generate a loss that offsets your gains dollar for dollar, reducing the taxable amount you owe at the end of the year. Investors have been using this strategy for decades, and robo-advisors now automate it daily, which means the wealthy no longer have a monopoly on a tactic that can save thousands annually. The IRS does have a wash sale rule that prevents you from immediately buying back the same security. So the move requires a 31-day waiting period, or a switch to a similar but not identical asset. Here's where it gets genuinely interesting and slightly mind-bending opportunity zones. Created under the 2017 Tax Cuts and Jobs Act, let you defer and potentially eliminate capital gains by reinvesting them into designated low-income communities. Invest your gains into a qualified opportunity zone fund, hold it for 10 years, and any appreciation on that new investment becomes completely tax-free, not deferred, free. 1,434 opportunity zones exist across the country, and real estate investors in particular have quietly been using them to compound wealth while their peers are writing checks to the Treasury. It's not a loophole. It's a government incentive that most investors either don't know about or assume is too complicated to bother with. Then there's the 1931 exchange, the crown jewel of real estate tax deferral, where you sell one investment property and roll the proceeds into a like-kind property without triggering a taxable event. You can repeat this process indefinitely, building a larger and larger real estate portfolio while the tax bill keeps getting kicked down the road like a very expensive can. Many investors have used 1931 exchanges to transform a single, modest rental property into a multi-million-dollar real estate portfolio across multiple decades without ever writing a single capital gains check along the way. The irony is that this strategy is completely legal, widely documented, and yet the majority of small investors have never had a conversation with their accountant about whether it applies to them. Let's be clear about the misconception that only the rich benefit from these strategies, because that's genuinely not true. The long-term capital gains 0% bracket covers individuals earning up to about $47,000 in 2024, meaning millions of middle-class investors owe nothing if they plan correctly. Strategy and sequencing matter far more than income level when it comes to reducing your tax exposure legally. The practical takeaway here is not to panic sell, not to chase short-term wins, and to build a relationship with a tax professional before you need one, not after the sale is already done. Process beats conviction every single time. And a disciplined investor who understands their tax exposure before pulling the trigger will always outperform the impulsive one who figures it out on April 14th. Discipline, sizing, and consistency are the three words that separate the investors who keep their gains from the ones who celebrate a win and then quietly write a very large check. At the end of the day, it's not just about how much you make, it's about how much of it you actually get to keep. Whether you're ready to explore real estate investing, need contracting work done, or want to connect with lenders who understand investor-friendly financing, we can help you get started. Check out the links in the description below.